Get my blue eyes off there. Hey guys, Tim Melvin. Welcome to Banking on Profits for August the 12th, 2023. I went with Saturday today instead of Friday. Mostly because I could and had a bunch of other stuff that I wanted to get done yesterday. You can't really see because it's home, but you'll notice that the closet doors in the background are gone. We're having all sorts of work being done. We're having some cabinets hung in there. So everything that was in the closets piled up around me like a little fort. We could hang blankets over it and have a good time. So a lot going on. So I said, you know what? I'm just going to do this on Saturday. It's a lot easier, a lot more relaxed. The phone's not going to be ringing. We can concentrate and focus. You'll note that I have my Florida formal wear on because after work today, we're heading up to Fort Myers. We're going to the roller derby. No, I'm not kidding. A few months ago, my wife's friend from the library gave her tickets to women's roller derby in Fort Myers, and she absolutely loved it. So tonight we're going back and we're taking my granddaughter. It is kind of fun, and it's an excuse to eat hot dogs. And popcorn and spend some time with the family. So that's what we're getting up to. I just get a tremendous kick out of it. Anyway, today we're going to start talk with commercial real estate. It's an issue. Everybody's talking about it. It's on the headlines. Um, Commercial real estate, if you believe all the bugaboos, going to wipe out every bank that ever existed. Everybody that ever owned commercial real estate, they're all going broke. It's going to happen. You should be buying put options on everybody that ever had anything to do with commercial real estate. And, exposure to it, I wipe out all life forms on earth. Apparently it can cause cancer. It can cause your wife to leave you for the pool boy. Your dog won't like you anymore if you get involved with commercial real estate. It's bad stuff. Let's see what's really going on, shall we? Now, we've talked about the banks. We know that most of our banks have very little exposure to the commercial real estate space. We've intentionally avoided it, mainly office. Okay, we do have some commercial real estate exposure. We've got a couple banks that are even heavy in CRE. We prefer owner occupied to non owner occupied because owner occupied that's a guy that owns the business and he's going to sweat, blood, sweat, tears, whatever it takes to keep the mortgage paid and keep his business going because defaulting on that mortgage is throwing in the towel. And that's the last thing he wants to do. I view that right up there. It's almost as secure in my mind as single family mortgages. It's a lot safer than non-owner occupied commercial real estate. We've got really low exposure to non-owner occupied commercial real estate in our portfolio. And yes, that's intentional. We have damn near zero to office. And yes, also intentional. However, looking at the commercial real estate investment trusts, and I picked out three, my favorite three. And by favorite three, it means, I've owned them before. I'm going to own them again shortly. Actually, I own Starwood at this point in time, STWD. Sam, Tim, Women, Daily. How's that? STWD. I do own that one. Love it. Collecting, fat dividends off of that thing. But let's just look because they all just recently released earnings and there's some information in for us in here. KKR Commercial Real Estate Trust, one of my favorites, affiliated with KKR. And if you've just joined us or never been with us, I'm a big fan of tracking closely and stealing ideas from private equity firms. They are the shock troops of the economy. Okay, if economists are the field generals, so to speak, KKR and the troops, they are definitely the shock troops. They're the boots on the ground. The ones doing battle out there in the trenches. Everything happening in the economy eventually shows up on the balance sheet and income statement of the private equity firms. They're running thousands of businesses all across the United States, and in some cases, like KKR and Blackstone and a few others, across the world. So it's going to show up. They talk about it on their calls. They are also heavily involved in the commercial real estate business, both as owners and as lenders. They both have REITs, or the two that I'm going to talk about today, the two private equity firms have REITs. KKR is first. That's Kindergarten, Ralph, Edward, Fancy, Cref. Really best in class portfolio. 99% of loans are paid as agreed. Plenty of liquidity for this REIT. The shares are currently yielding 14%, about 60% of book value at the moment. The parent company, KKR, owns 14%. That's one of the largest insider ownership percentages in all of commercial real estate REITdom. Mostly floating rate rent loans with floors. Loan to value is about 65%. Very minimal default rates in here. Very minimal troubled. It's like less than 2%. They do have office exposure. They've got some of what they call class 5, which is their higher end exposure. They've actually been working a lot of that out. They're not afraid to take it. They talked on their conference call about, look, if they default, we'll take it, run it for a few years and sell it when we can sell it at a profit. And a 65% loan to value, except for extreme examples, they can take it and sell it and break even on the loan now. No, they'll have their operating folks come in. Remember, they own billions, hundreds of billions probably of real estate around the world. No problem coming in and running a property until they get a bigger gain on the thing. So on their balance sheet, they have no maturities until the end of 2025. Here's what you really need to know about commercial real estate right now. They're not worried about their existing portfolio. They think it's fine. They've got the low loan to values, as do most banks, 65%, about the national average for banks as well, last time we looked at those numbers. But they stopped lending in the quarter. There's headline risk all over the place. Actually, there is bad thing. Bad things are happening in office. They have no interest in catching the refi of people that are trying to get away from one lender who doesn't want to roll it over, and they're desperate now to get financing. KKR does not want to be in that game. They don't want to be in that business. They're sitting on the sideline waiting because they know that as this goes on, opportunities are going to be created. And the people with the money to lend, when all the dust is done, right? At the height of the battle, okay? When all the bodies that have fallen are already fallen, and what's left standing is the good credits, and the distressed players start to come into the arena, that's going to be the time to be a lender because you're going to get fat, juicy interest rates. You're going to have loan to values that ridiculous percentage of what the properties will ultimately be worth. And it's really low risk stuff. So they are sitting on cash, waiting to move into the market, primarily in office. But again, here's the key. They're not really concerned about their existing portfolio. They consider it money good. And in fact, they're throwing out cash. The distributable earnings are covering that dividend. It's trading at a whopper of a percentage of book value right now. We're going to end up buying this. Kind of hoping they cut the dividend so all the yield hunger will get out of it, and everybody will panic out, and I'll get this thing at a stupid price. We'll wait and see how it plays out. The market's got a little sloppy last week, so we'll see. Maybe we'll get our chance. Then Blackstone Mortgage Trust, $23 billion portfolio, and again, KKR has a 65% loan to value. They've got a 64%. They're actively de-risking the portfolio. They've got, if it's garbage, it's gone, basically. Now, what's left? Much like KKR, they're not worried about what they own. 96% of it's performing. They're not too concerned about their office exposure. What they do have, they, again, highly confident that they can work out. They're the largest owner of real estate in the world, I believe. If they're not one, they're two. So I don't think they're concerned about having to take over an office building and operate it for a little while and then eventually sell it to get all the money back for the loan. And again, at a 65% LTV, they can only come out losers on really extreme situations, loans that they made at the absolute single worst moment in time at the worst possible valuation. Blackstone's been around since the 70s, and they've consistently made money, just like KKR. So I'm pretty sure they weren't stupid enough to do that, but I could be wrong. But not worried about the portfolio. like KKR, building liquidity, reducing leverage. They've increased their reserve for losses. So did KKR. And again, both of these really focused on coastal and Sunbelt markets, which is, if you're buying REITs, that's good information to have. Um, Total loans slightly down year to date. KKR's was just about even year to date. They're not making new loans. They're going to sit and they're going to wait. We're seeing that with our banks too. Not worried about what's going on, not making a lot of new loans for a variety of reasons. Commercial real estate, it's the new loans that have everybody scared. The fear is really widespread across all asset classes. It should not be. The problem area of the market is office. Office, office, office. And let me say it again, the problem in the commercial real estate market is office. It's not multifamily even. I know I see the headlines. They're ridiculous. Yes, there is a lot of supply that came online. Yes, rent growth has slowed. Say that sentence out loud. Rent growth has slowed. That doesn't say rents went down. Okay. Rent growth has slowed. Now, it's very market specific, and it's one of the reasons we've always liked Home Street, although it's on the whole list because the capital levels are really low. But, they're in rental markets that we love. Now, I'm not much on office in San Francisco area, not much on parts of Southern California for office, not much for Seattle in office. Absolutely love multifamily, because just because they don't want to go to the office doesn't mean they don't want to live there. A lot of people are willing to pay up to live in these areas, same as Honolulu. So we've got multifamily lenders in the portfolio. We like the markets they're in, and we do not expect there to be any problems. Blackstone, KKR, both same thing. We're just not losing any sweat over our existing multifamily loans. Nobody's making any new ones because that last wave of supply was enough for now. We've talked about this, so I don't want to beat a dead horse, but remember, housing affordability, a lot of people that would have moved up and out of multifamily still there, because when you go from 2.5% to over 7% Friday for mortgages for good credit, the affordability equation changes. And it's much like my son. He spent the initial couple of quarters like, we can wait, and he's like, all right, look, we've got the baby, we got two big dogs, we're kind of thinking another baby might be good, hoping for a boy, just put the power of positive thinking to work for me out there. Okay, we got two girls already. But so they're thinking of expanding. Okay, it's time. We need to buy a house, and they can afford it. He's doing really well in his job, and she's doing really well at hers. So, they can afford a nice house in wherever they are. They're up in the Orlando area. They've just got to readjust their brain to that new mortgage. That's kind of happening slowly, but they're still in multifamily, and that's happening all across the United States. So a wave of people that should have moved up and out, they're still there. So multifamily is actually much better than the headlines would have you believe. And then, industrial, digital infrastructure, all good. Office is the problem. We've avoided office. And finally, Starwood, the one we do own, this is Barry Sternlicht's company. They're very conservative. They're building liquidity. Again, avoiding making new loans except for cherry-picked situations. They have very small exposure to the office market. They've intentionally cut it back. They're a little more diversified than the other. Everybody else seems to be wanting to lending in the coastal and Sunbelt regions because that's where people want to be. Starwood has been a little more willing to go into parts of the Midwest and that sort of, into Mountain West, that sort of thing. They've also got some Europe, Australia, and Bahamas. And I want to know what they lend on the Bahamas, because it's got to be the big hotel and casino complex there. I can't imagine what else you'd make a loan on in the Bahamas, but probably wrong because I haven't gone through the 10K yet or to see exactly, because I think that's new. That wasn't there last time I looked. Anyway, they've also got a great infrastructure business doing energy infrastructure. And they point out, look, this is a great business. Renewable is coming on, but even in traditional, right? if we hit all of our maximum goals for electric vehicles and artificial intelligence and all the wonderful things that are supposed to happen there, if we hit them overnight, you know, energy needs explode higher by over 30%, which means massive new infrastructure. So it we're going to be collecting rent on that stuff for a while. We absolutely love energy infrastructure and have for several years now in whatever format. They've got a great medical office business. So, you know, Sternlicht did make a comment, and I'm going to touch on this because they're very concerned. They're not as sanguine about inflation as a lot of the headlines and other observers. Neither am I, as you know. Um, they are concerned because you've got the Fed trying to really crack, monetary policy to slow the economy. Then you've got absolutely unchecked, wildly out of control, and constantly growing government spending at every level that can afford it. You got some states that can't afford it, but every state that's got a couple nickels, they're throwing it out into the economy um, because it buys votes. And it puts a lot of pressure on the inflation meter. So then, let me just see. One thing that interesting, because I also listened to the Apollo Global, and Apollo Global. I mean, if I had a Spirit private equity firm, it's Apollo. They came out of the Drexel Burnham mess. They've done distressed debt. They're really hardcore value guys, and so I identify with those guys, and it actually made a lot of money stealing their ideas over the years. But they pointed out that on private credit, a lot of what we're seeing as private credit is lower grade credit to middle market businesses, business development company type stuff. And you could get higher default rates on that. What they're seeing is a move towards private credit that's investment grade, cutting the banks and the securities market out, particularly for asset-backed finance, which is interesting. There's nothing we can really do in that area right now. But we're going to keep an eye on this because this could be really super lucrative. We saw some big deals from Air France and some other folks that normally would have done a securitized bond offering. They went the private credit route. So we could get that into a REIT. I think I'm real interested in owning a whole bunch of that thing. We'll keep an eye on that. So anyway, then the big numbers this week, CPI numbers said everything's good. Inflation going back in the box. Dragons going in the cage. It's all good. Next day, the PPI numbers came out and said, wait a minute. And again, if you go through all of the CPI numbers, the only thing down year over year in size is energy. Used car prices are down a little bit, but how could they not be after what used car prices were a year ago and 2 years ago, as there was no new car supply because of the semiconductor shortage. So used car prices are coming back to reality, much to the chagrin of used car dealers everywhere. But so energy did not really show up big in the year over year numbers here. And there was, a little bit weaker as it hasn't flowed all the way through to the end user. Because remember, we've seen a big bump in oil prices, and even natural gas is up a little tiny bit. So energy prices are moving higher. Eventually, that's going to show up in the end numbers. Now, producer prices came out the next day and said, wait, let's talk about this. Services still leading the way higher, and it's higher across the board. Food and energy also higher. And again, this is producer prices, not yet in consumer prices. Look, everything that's in the producer price numbers, that if you're out there and you buy your own groceries, you pump your own gas, you pay your own electric bill, you already knew what was in that report. Everything cost more. So if this is all, so we look at it, going to put pressure on the inflation numbers going forward. The consensus is that Jerome Powell will have room to pause in September. Maybe. If you get another CPI print like that, absolutely. If some of that high energy begins to filter over into consumer prices, nope, you will not get a pause. You may get another hike. Look, a lot of the Fed governors are still running around, guys, and they're saying two more. Stern looked at his remarks, said, maybe another 1.5%. That's a lot more hikes. So we'll see. But they may not be done at the Fed. I think as we've said all along, they're closer to the end than the beginning. Um, but you've got some issues in food prices. You've got some issues in rent prices, and I think you've got major issues in energy prices that could still make the inflation fight all that much more difficult. Looking at the bank numbers, just kind of going through the call report data. And once again, a big thanks to Bill Moreland at bankregdata.com because he saves me hours. I mean, I owe him a huge dinner. So I'm glad he left the state of Texas and moved up north because we actually occasionally go to Texas and I'd have to deliver on the dinner. But wonderful, one of the best data services for banks. So earnings are coming in much, much better than expected. And I'm going to be glancing over here because I want to make sure I get my notes right. Loan growth, there was positive loan growth in the quarter, guys. All those headlines, loan growth falling off. Loan demand has died down substantially. However, they still went up a little bit less than 1%, but they went up. And where the big number was, mortgages. Okay. Slowly but surely that acceptance of the new normal is coming in. And, you saw a big wave of new home sales because there are people that have to move and they got up on the deadline and they said, screw it, we're moving. Regardless, it's job or whatever the reason is, you've got to buy a home now. That was just a surge of new homes. That's going to back off quite a bit in the quarters ahead. But we saw it, and it showed up in the mortgages. So those numbers were fantastic. Almost 82% of banks, 81 point something of banks had loan growth. That's up from 67% in the first quarter. I do think a lot of that was that spike in single family homes, some businesses getting positioned at the best possible rate before rates roll over higher. Net loans and leases are up a little bit. We also saw the banks, especially the big banks, they're cutting back on securities where they can. They took advantage of the rally in fixed income to lighten up on securities because we've talked about this. Michael Barr is shopping his new regulations around. I don't see any way to stop him. And so we could very well see, capital levels go up, which requires repositioning of securities towards more liquid stuff, less longer term, and changes in securities accounting. The larger banks actually have to account for securities mark-to-markets quarterly in regulatory capital, not just GAAP accounting principles. So, going to get out of what you can get out of when the market lets you, and we saw some of that in the quarter. Credit cards they jumped up higher, $45 billion. Commercial real estate was actually up a little bit. So was multifamily, but just tiny bit. But as we said, consistently, I think for the last couple of months, summer is going to be good, and that's showing up. The activity's still there. It's dying off. It's dying off dramatically. Most banks are saying their loan pipelines are pretty empty at this point, particularly on the commercial side, as credit standards have tightened quite a bit and demand is decreasing also quite a bit. Some cracks showing in credit cards and auto, as that's always the case. They're the ones that show the first cracks. Look, folks, it's not that bad. If you look at family debt levels, all this scary stuff about consumer debt bubbles, because consumers, that it's total 100% complete BS. All right. Debt to service ratios on the individual level are really reasonable. They're closer to historic lows than they are. They're nowhere near historic highs. Now, yeah, they're borrowed more. Okay. Especially on mortgages. You know what? They bought a lot more. They also have higher incomes. All right. They have higher net worths. They've got higher equity in their homes. They've got lower interest rates on their homes, so they could borrow more. So, only 2.7% of all debt, including mortgages held by consumers, is in any state of delinquency or default. Not a problem. Okay. Now, you want to talk about government debt. You want to talk about, commercial and industrial debt. That's a different discussion. And there are signs of debt bubbles there, but not right now by any stretch of the imagination. We're still a very, very long way from serious problems in the consumer loan market or the mortgage market, which is why we love our banks full of single family mortgages. And again, it's all drying up. Demand is going down. And I think we're going to see single family mortgage begin to decline. However, money good on the existing portfolios. We lose no sleep about the mortgages owned by our banks. Now, yeah, it's coming down to my notes. Okay, one question I get, and I get this a lot. Why the Fed, Tim? Why are you always talking about the Fed? We hate the Fed. We want to burn the Fed down. The Fed is killing America. It causes wars and pestilence and the apocalypse. And, it should be the fifth horseman of the apocalypse along with the other four that we're talking about in the Bible. They abduct small children and sacrifice them to Moloch. Everything in American society that is wrong is the responsibility and fault of the Federal Reserve. Why would you talk about that? Jay Powell hates puppies. Everybody knows that. Look, let's audit the Fed. Let's end the Fed. Let's destroy the Fed. Let's just burn that building down. Look, let's be honest about this for a second, okay? You hate the Fed? You love the Fed? You want to audit them? You want to end them? Doesn't matter. You can't. And the Fed doesn't care. We're stuck with the Fed. This is our monetary system. This is the global monetary system. We could not go onto a gold standard or commodity-based currency standard without destroying our economy, because the other nations would quite correctly arbitrage us literally out of existence with their fiat currency, or we'd have to end all global trade, which means no more Mercedes, no more BMW, no more French wines, so also not realistically a solution. So you want to go back currency? It doesn't matter. You want a commodity-backed currency like Ben Graham wrote about in his 1937 book, Storage and Stability? I love the idea. Doesn't matter. You want the Melvin coin, backed by, Kindle Unlimited books, bourbon, and chicken fried steak? Doesn't matter. How about the Melvin coin as designed by my wife and my cardiologist? That would be fresh fish, kale, berries, and statins. Also doesn't really matter what you want. Now, the one thing I'll say, and then I'll move on to the rest of it, you can't change what's at the Fed. Now, a central bank digital coin, not a fan either, especially because it's programmable. And I just think there's a lot of bad endings down that particular path. I'm a big fan of cash remaining in circulation. But remember, the Fed can't actually create a central bank digital coin without congressional approval. So check in with your congressman on that one if you have a strong opinion on it. Commercial over. The Fed is what we have. It's what we're going to have. We can't change it without taking to the barricades. And I ain't going. If you are, best of luck. I think it's going to end badly for you. There's a lot of reasons we're stuck with the Fed. Some good, some bad, but they are what they are. So we can bitch about the Fed. We can complain about the Fed. We can rant and rail and scream about the Fed. It doesn't do any good. It does nothing. The Fed's not going to change. We can't change the policy. We can write 1 million letters to our congressman and to the president and complain about the Fed. It won't change anything. Okay. So we can rail about the Fed. We can bitch about the Fed. We can complain about it. We can use it to scare the hell out of people so that they come to our website. Or so what? You can't change anything. It's what we have. So what can we do? Well, the Fed is going to set interest rates and they're going to set monetary policy. That's the way this works. So monetary policy and interest rates, well, that impacts the banks, and we buy banks. So the Fed is going to create opportunities by what they do with interest rates. Our job is to spot those opportunities. When we can find banks that have lots of capital, strong balance sheets, excellent credit in the loan portfolio, trading at reasonable, actually I prefer unreasonably cheap valuations, and most importantly, have lots of capital. So they're in a position to weather any storm created by Fed activities and benefit from the tidal wave of economic activity that comes from the reversal of negative Fed policies, we're going to make a lot of money and always maintain a margin of safety. So we can bitch about the Fed, or we can learn to understand that the Fed is going to create opportunities to make money and opportunities to protect our money. So our job is to spot those opportunities. Now, here's the other thing that I actually love about the Fed. The Fed, they're going to create these conditions, right? They're also going to give us, I would say for free, but we all pay taxes, so it ain't free, but it's embedded in the federal income tax, and you can't do much about that either. Again, it's Congress. That's the most dysfunctional body, I think, if not on the face of the planet. I mean, it's only the Italian Parliament and a few others in the developed world that make them look reasonably sane. It's tough to get stuff done there. So it's not free, but it's there, and you're already paying for it in your taxes. So all the information we need to identify these conditions and spot the opportunity, and which opportunity, where we are in the opportunity cycle, they're there. They're free, sort of. But so we can access all the data. And a lot of good young economists and analysts, their first job out of college, they cut their teeth crunching data for the Fed. Right, which is thoroughly reviewed and analyzed and corrected, and it's made available on the website, and we can use it to inform our decision-making process. So why do I talk about the Fed? I love banks. Banks are influenced by the Fed. We're stuck with the Fed. Can't do a damn thing about it. So let's just stop screaming about it. It's a waste of time and energy and vocal cords. Let's learn to spot those opportunities created by the Fed, use all that data and information to make money. So wherever we are in the economic cycle, as controlled or influenced by the Federal Reserve, we are in a position to profit from it and protect what we already have. So quit bitching about the Fed. You can't change it. We're stuck with it. Let's use it and all that lovely information they give us to make money as long-term bank stock investors. All right. Now, buy list be out shortly. No big changes on it. William Penn has appreciated, but I'm going to leave it on the buy list because of the capital levels. It's like almost 20% equity to asset. So what I'm going to tell you is, with William Penn, the prices, thanks to the buyout programs, it's up there. We're a little bit over tangible book right now. Buy it on pullbacks, okay? So maybe I'll go ahead and take it off and put it back on when we get a pullback and it's expected. Yeah. But anyway, so that'll be the only change. William Penn coming off. Everything else still, priced at a discount, still lots of capital. We are not adding lower capital level banks back on at this time. Now we're going to start to see those capital levels come up. And I think when all the call reports and reports are in finally, and we've seen all the earnings reports, and we feel comfortable computing the equity to asset levels again, based on the second quarter, we'll revisit this. And those that are back over our threshold will add back to the buy list. Capital is king where we are in the cycle. We're not going to abandon that. Our banks have more capital, higher insured deposit levels, lower securities holdings, little to no office exposure, lower commercial real estate exposure than the average bank, more single-family mortgage coverage, and lower non-performing assets. And we're sticking with that all the way through. We're building as big a margin of safety into our portfolio as we possibly can. We're going to continue to do so. Not going to play loose with this here, guys. Still a lot of headline risk, still a lot of economic uncertainty, no matter what the headlines may be telling you at the moment. So anyway, I've taken more time than I probably meant to or should have. Hopefully you're able to stick with it. I'm going to go ahead and get a transcript of this week's too, so that'll be up. Don't expect that every week, but I do want to get a transcript of this week's just for the note purposes. So anyway, I'm Tim Melvin. We're going to roller derby. I don't know what you're doing the rest of your weekend, but I'm going to roller derby with the family and the granddaughter. Everybody's going except the dogs. They get to stay home. And we're going to have a good old time. And then tomorrow, we're going to go to the beach because we live in Southwest Florida and that's what we should do, even though it is blistering hot outside. So, guys, have a fantastic weekend. Next weekend, going up to New Smyrna Beach, one of my favorite little beach towns on the Atlantic coast. My son and the youngest granddaughter, and of course his wife, they're coming over, and we're just going to hang out and we're going to eat food and we're going to play on the beach, and because we just don't see them as much as we'd like to. So that's how we're spending next weekend. Those of you that have been around a while know what that means. It's a publisher's holiday. Unless something goes dramatically right or wrong, you won't hear from me next week because I will be playing with a certain 1.5-year-old granddaughter on the beach and showing her the wrong way to build sandcastles because I'm clumsy and not good at that type of stuff, but we'll give it the old college try. All right, guys, have a fantastic weekend. We'll talk again in 2 weeks because this is one of my rare and infrequent mini vacations coming up. If something drastic happens or we get takeover activity, I'll get it out to you. So have a great weekend and great week. Thanks, guys.